right, everyone. Now we're going to shift our attention to talk about freight. Now, freight is very, very important, as you guys can imagine, because this is once we buy and sell the merchandise, whether we're on the buy side or on the sell side, depending on what hat we're wearing at the time. Some kind of way we got to get the merchandise to either get the merchandise from the buyer to the seller or from the seller to the customer, right? It just depends on, again, who you are in a situation. So that's what we're going to talk about is how do we get the product from point A to point B? Yeah. So this is where these terms come into play. So we have two freight terms. One is FOB shipping point and one is FOB destination. So now the terms of the sale indicates when ownership or title exchanges hands, okay? So let's talk about first FOB, shipping point, okay? So FOB shipping point is is when the buyer, I can mark this up for a second, is when the buyer is responsible for freight. The buyer pays for the freight, okay? At that point, the buyer adds the inventory, the cost of the inventory to its, they're adding it to their inventory. It is their inventory. So as soon as the sale is made, the title passes to the buyer at that point, okay? Now in FOB destination, which is this one, FOB destination is when the seller is paying for freight, okay? And this is when the seller is reported, it is reported as delivery expenses, and then expenses are usually reported on the income statement, okay? And then usually the seller usually builds freight into the sales price, so they're not taking a direct hit. So what I want to make sure that I get across to you guys is that when it comes to freight, neither the buyer nor the seller is really picking up the cost. And hear me for a second. It is FOB destination, which we're talking about now. They're building that the freight expense or the delivery expense into the selling price to the buyer. Now, if the buyer is paying for freight, FOB shipping point, then usually when they sell it to their customer, they're gonna, whenever we go to buy it from them, instead of the price being $9 for said item, it is now gonna be $9.20. And what that 20 cent represents is the cost of delivery, right? Or it's part of the inventory cost. And so we're just passing one cost to another person, right? They're some kind of way picking it up. Okay, so hopefully that made sense to you. All right. And because I've worked in freight before in my prior jobs, I like to always talk about the scenarios in which sometimes accidents happen, right? And when accidents happen, we just need to be sure to understand who is responsible for said accidents, right? So it's always a good one just to talk about, but I'll spare you guys that information. But last but not least, what I really want to spend the rest of my time talking about is looking at the transactions between the purchase, what it looks like from the purchase and the sales side. So if I am, from like Shure and Blue Star. So if you are following along with the examples, I believe this is the very last example that we're going to talk about. Okay, so I'm going to switch applications. All right, so here we are. So we have Shure sold merchandise to Blue Star on account, and it was $112,000. The terms was $210 net 30, and the cost of the merchandise was $67,200. Shure co-paid freight of $1,800. Okay. It's asking us to journalize the entries for Shure and Blue Star for the sale, purchase, and payment of the amount due. Now, this is a perfect chance for you guys to stop and see if you can kind of figure out how to attack this. But no worries if you don't want to. I completely understand. But we're going to walk through this example from their experience of both of them. So when we're purchasing it and when we're selling it. So in order to do so, you need to identify first who's who, right? Between Shore, Cole, and Blue Star, who is buying and who is selling. All right. And so in reading through this, it looks like Sureco is the seller. So the seller is going to be Sureco. And then it looks like, again, from experience or reading through this, if the seller is Sureco, then the buyer has to be Blue Star. Okay. So we're going to look at what does it look like for both parties to record the same transactions on their book, okay? All right, so let's go all the way through with Sureco, the seller. So let's continue on this one. So we're saying here, we're recording it from Sureco. All right, so what we have is them selling it. So what we're going to do is they said it's on account, right? So when we first record it, it's going to be a debit to accounts receivable, right? And a credit to sales. Now we need to figure out what the amount is. So again, as we've mentioned before, we're always going to assume that they're going to take advantage of the discount. And so in order to do the discount, again, it's going to be 100. Sorry, let me make this a little smaller. All right, so on this side over here, I'm going to just do the calculation. It's going to be $112,000 times 98%, which is the buyer, which is Blue Shore, will be responsible for. So if I did 112,000 times the 98%, that came out to 109,760. Okay. So if I am, again, working through this example, that's what I'm going to record. I'm going to push this over to the side a little bit. So give me a second. Okay. All righty. All right. So our total came out to be a debit of 109,760 and a credit to sales 109,760. All right, and it said that the cost of goods sold to them, so let's not forget that part. So our debit is going to be to cost of goods sold in the amount of 67,200, and then my credit is going to be to inventory. That is what's decreasing. Okay. All right. So then it says Sureco, which is the seller, is paying for freight. All right. So in our prior slide or our earlier video, we talked about freight. And so if the seller is paying for freight, the journal entry to record that is a debit to delivery expense. And the amount is for $1,800. And my credit is going to be for cash. Right. All right. And then lastly, so it says, make sure you journalize the entry for the sale, which we've done, and then the payment of the amount. So we're going to assume that they're going to pay within the discounted period. So the journal entry to record the buyer paying within the discounted period is going to be a debit to cash in the amount of 109,760, and my credit is going to be to accounts receivable 109,760. So from beginning to end, you see how the seller has treated this transaction, and now we're going to move on to the buyer, right? So this should be somewhat of a mirrored transaction for the most part, but there'll be small deviations because who's responsible for what. But let me take you through this. All right, so we have Blue Shore. Going back to the earlier portion of this this example or this chapter, we're doing, if they're buying or if we're buying inventory, it's going to be a debit to inventory. And we're going to take advantage of the discount. So our inventory is going to be 109,760, and our credit is going to be an accounts payable if we're promising to pay it later. So if it was a accounts receivable to them, it's accounts payable to us. We're promising to pay it in the future, right? All right. And so now the next part we need to look at is we don't have to consider freight, right? Because SureCo is the one paying for freight. So we can skip this. We also do not have a cost of goods sold, so that is not applicable to us. Delivery expenses is not applicable to us. The only other thing we need to account for is paying this within a discounted period. So to do so, we're going to do a debit to accounts payable in the amount of $109,760 and a credit to cash. Our cash is decreasing because we're paying off what we owe. And so from start to finish, as you guys have seen, this is how to do it. There's a lot more transactions taking place on the seller side for obvious reasons, but this is what it should look like when we are accounting for both of the transactions from the seller and the buyer side.